Hello, and welcome to episode 18 of the Life and Finances Together podcast. We want to thank our audience members who have liked and subscribed and encourage you to make that click today if you haven't already. On today's episode, our financial professionals, Roger David and Jake Reinfeldt, will be talking about the important things to know concerning 401k rollovers, which is a common topic in meetings. There's a lot to discuss, and I know you're both eager to share, so tell us all about it. Roger?
Well, everybody at some point in time has probably left a job or maybe some people are just getting to retire. So there's this thing called this 401k rollover. I mean, very widely known. What do I do? What do I do with this retirement plan from my previous employer, or maybe it's previous employers, right? What do you do? What are your options? Well, there's two main options that you can take advantage of.
Yeah, correct. The main option is doing a rollover, right? A 401k rollover. There's two different ways that you can accomplish it. One is totally preferential, the one that we're going to want to do whenever we can. It's called a direct rollover. The direct rollover will send the money from the current custodian to the new custodian. So whomever is managing the custodian of your 401k plan will send the money either via check or electronically to the custodian of the IRA or Roth IRA that we've set up to receive those funds. Easy peasy. Money moves over. No tax situation, a tax-free event. Simplest way to do it. The more complex way and less ideal way is what's called an indirect rollover. And that's something that we try to avoid at all costs when we can. An indirect rollover is actually going to cut a check out to you in your name, and that starts a ticking time clock of 60 days.
Right.
That check that you receive is going to be 20% less in your account value because they're going to automatically withhold 20% for taxes. You're going to get that check, and you've got 60 days to get that money from the check that you've received into an IRA or a Roth IRA to complete the indirect rollover. If you do it on the 61st day, you've taken too long, and the entire account value is going to be deemed taxable. And you can only do this once every 12 months.
You might have some penalty with it too.
Yeah, and there's penalty. So it sounds, the wording is so similar, but the implications of a direct rollover versus an indirect rollover are vastly different. So that's why completing a direct rollover is ideal and what we would always recommend that clients do.
So be careful of that when you're looking at that. And again, there's maybe a little bit of misconception. If the current custodian of the 401k or IRA makes the check out to the new custodian, that is a direct transfer, right? You might receive the check at your home, but it's made out to the new custodian, the new holder of your money.
Yep, exactly.
If they're making it out to you, that's the difference. Now you've taken kind of possession of that money, and you're going to have to write another check right to the new custodian. So understand what that means. Don't get too scared. So if you're saying, oh, hey, they made it out to the custodian, they sent this check to my house. Okay, as long as it's made out to the new custodian who's holding the money, you're okay.
Yeah,
it's a direct transfer. It's all right. Right, even though you got the check. The other thing, too, is there's these things called in-service withdrawals. And usually that happens when you're 59 and a half, right?
Yeah, exactly. So in-service withdrawals or rollovers are an opportunity you can take advantage of in your plan to diversify on the investment side, take money out of your account sooner than your retirement age if you'd like, or to take a distribution from your account.
You're still in the plan.
Yeah, you're still
in the plan with your employer,
exactly,
right?
Yeah. So you're still able to contribute to it. You're still able to get your matching contribution. Oftentimes, for the topic of this podcast, it's, hey, I want to roll some of this money out and diversify so that I can invest a little bit differently than what's available. Sometimes just 10 to 12 funds, most of which are target retirement date funds in my retirement plan at work. For most plans, the average, that age is 59 and a half. So once you reach 59 and a half, you can implement this in-service rollover, in-service distribution, but it is plan specific. Some will allow you to do it as soon as age 55 or any age in between. So you actually have to look at your plan documents or talk to someone in your HR department to figure out at what age can I process an in-service rollover or withdrawal from my 401k plan.
Yeah. And like Jake and I will look at quite often, you want to look at the cost. What's the difference? What benefit are you getting from this? There is benefits in most cases from a diversification or a strategic standpoint of managing the money, right? But then also, make sure that whoever you're working with or you're doing it yourself, make sure you understand what the cost factor is on this as well. So the other thing too that gets kind of missed is what type of money do you have maybe in your 401k, right? So many clients when they come in, Raj, I don't remember what I did 20 years ago. I don't remember what I did 10 or 15 years ago. Heck, I don't remember what I did 2 to 3 years ago. And with the number of times that people change jobs, so many of our clients that come in to begin to work with us have plans all over the place, right? From all different employers that they've had over the years. Well, they can't remember how they funded some of these plans. Some might be what we call traditional funding, where we're looking at this and saying, hey, we made a contribution, we got a tax deduction, their earnings grow tax deferred, but when we withdraw them, they're going to be taxed as we take it out. The other more recent, kind of not that recent, but maybe in the last 10 to 15 years, the Roth 401k, right? And you can do a traditional 401k and a Roth 401k contribution all within the same plan. Well, the Roth, you don't get a tax deduction on the contribution, right? It grows tax deferred, actually grows tax free because the withdrawals, when you start taking them out, tax free. The other one that's kind of less common, it was more of something that we saw in the early years of 401k, is people would make contributions in their 401k that the contributions were not deductible. However, their earnings still grow tax deferred, right? But when you withdraw them, you got to pay taxes. That's an even more complicated thing because then you got to track, hey, what did I put into this thing that wasn't tax deductible? And now I'm paying taxes on the withdrawal. Mm-hmm. So before you do a rollover, right, maybe from previous employer 401ks to an IRA of your own, you're going to want to make sure you know what's in there.
Yeah.
Right? Because you're going to set up different accounts.
Yeah, exactly. And those of you who have never made, for example, a Roth contribution in your working career, you may be making them now going forward if you earn too much money. Because there's the Secure Act 2.0 that stipulated if you're making catch-up contributions in your 401k plan and you earn over a certain dollar amount of income, the IRS is going to make your catch-up contributions have to be Roth contributions.
And that's not a bad thing, by the way.
No, it's not a bad thing by any means. But it may be something that you didn't anticipate. You're going to start to see a line item in your pay stub, for example, and you're going to start to see on your statements Roth money building up in your account that you had never done before, that you may have never actually elected yourself. Well, that's something that may be coming down the line. So you have to be cognizant of the types of money in your account. But even a step further, you also need to be cognizant of if you have company stock inside of your 401k plan.
Yeah, and that one gets a little more complicated. And this is where there's just really bad mistakes that are made when it comes to this. If you work for a company that had publicly traded stock, and let's just say you got, I don't know, a few $100,000 in there, call it $500,000, along with the mutual funds or other investments that you funded in your 401k. Well, you may be eligible to participate in what we call net unrealized appreciation. So what does that mean? Well, let's say you had company stock the time that you're getting ready to retire, it's worth $500,000. When you ask the custodian, say, look, what do I actually have into this thing, right? What was this stock given to me at? What value? And all of a sudden you look at this and say, wow, the stock's worth $500,000 today because the share price went up. But actually when I received it, my basis, what I quote unquote kind of purchased it at was $50,000. So you're thinking, wow, what's my option? Well, the option is to say, look, I'm going to take this company stock and I'm going to put it in an account in my own name, not in an IRA, but just an account in my own name. And you know what I'm going to do? I'm going to pay the tax on the amount that the value of that it was given to me. So in this scenario here, $500,000 worth of company stock. Hey, the basis or the value that it was gifted to you was at $50,000. You're going to pay taxes on the $50,000. Okay. But then the $500,000, and really how this works also is you're going to have the money in your pocket to pay the taxes. So when you do this, you don't want to really have to do anything on the IRA. You want to say, look, I'm going to take the money from the 401k, transfer the stock to my IRA, right? And I'm going to pay the taxes out of my pocket on the basis, on the $50,000 value that basically I bought the stock at, right? That's what you do. And why do you want to do that? Because if you leave the $500,000 in there and you just roll it to an IRA, now all of a sudden that $500,000 fully income taxable when you start taking that withdrawal out of that IRA. If you say, look, I'm going to roll this stock to an individual account, non-IRA, pay the taxes on the $50,000, the value that was granted to me, and now I'm going to start taking withdrawals. I'm going to start selling some of this stock. Well, that's a pretty big gain, 50,000 basis and 450,000 in gain, but the tax rate is usually going to be lower. And it could be 0, could be 15, could be 20%. And those rates are usually lower than the income tax rates that you'd pay just blindly rolling it all over to an IRA. So this net unrealized appreciation, if you've got company stock that you've owned for a long time, it is absolutely worth your while to say, what did I pay for that? Or what was the value that it was given to me over all these years? Figure that out. Mm-hmm. If you're talking about our example, where you're saying, look, I only pay income tax on $50,000 versus $500,000 in the stock value, it might be very well worth your while, right? You're going to want to look at that and seriously consider that. The other part of this too, when you're looking at 401ks, right, and what do you do, when do you do it, is this rule of 55. Mm-hmm. Right? So the rule of 55, what does that deal with?
Yeah, so like Roger had said, a lot of people leave and switch jobs multiple times throughout their career, ultimately leading up to retirement one day, right? So let's say you've consolidated these accounts, you've got one 401k plan, and you're retiring at age 55 or 56. If you were to roll that money to an IRA and start immediately taking withdrawals, unless you set up a 72T, which is a whole nother topic that we can get into in a later podcast. If you take those withdrawals at age 55, 56, you're paying a 10% early withdrawal penalty.
Right, because you roll it to the IRA.
Yes, because you're under age 59 and a half, which is such an arbitrary number when you hear like a half age, but that's the IRS's guideline. If instead you keep the money in your 401k plan and you're age 55 or 56, you can take a withdrawal from the 401k without that 10% early withdrawal penalty. That's the rule of 55. In either scenario, you're still paying the federal and state, possibly, income taxes, but this allows you to avoid that 10% early withdrawal penalty, right? So that's something that just your age can determine what the better scenario is, and it allows you to avoid those early withdrawal penalties even if you're under that 59 and a half mark, if you're between 55 and 59 and a half. So it behooves you to keep the money in the 401k plan and take the withdrawals instead of rolling it out to an IRA. So lots of different intricacies and complexities to something that seems so simple. 401k rollover, well, there's a lot that goes into it.
Yeah, and we're just talking about a few of them too. So, when you're looking at this, you're going to want to make sure that you're looking at what's the cost, right? What am I getting into? What are the benefits of going to an IRA over my 401k? Talking about the rule of 55, that's a pretty big deal. Most people say, yeah, I don't know if I really just want to retire at 60 or 62 or 65. Maybe I want to go early. Maybe I'm going to work part-time. Whatever that scenario is, you want to pre-plan this out. You want to have this in your financial plan to understand what's the game plan going to be. How am I going to get access to this money? And how can I do it while minimizing the taxes, right? So when you're talking about 401ks, when you're talking about, well, am I going to do a rollover? Am I going to take advantage of the NUA? All this, again, it's a coordination. A coordination of all these different things that we've talked about is truly what brings life and finances together.
Thanks so much for watching, for listening, and for learning about 401k rollovers with us today. For questions about our financial services or finances in general, please check out our website. That's reinveltdavid.com. Send us an email, give us a call, and of course, please like and subscribe to our podcast and stay tuned for our next episode.
This podcast is for entertainment and educational purposes only and is not intended as personal financial advice. Before making any financial decision, please do your own research and consult a financial advisor as needed.